Hey, welcome to DayTradeToWin.com. Today I wanted to go through some more candlestick patterns, but one thing that I really want to point out, and I mentioned this earlier in a previous episode as well, is that you should look at candlestick patterns as principles instead of exact patterns. You need to look at the whole picture, the whole chart, instead of just mechanically look for a candle or a few candles that look a certain way. You see, if you could look only for specific patterns, like one of the reversal patterns we had a look at in the last episode, and then enter a trade when you find one of them. If that was possible, we could just program an algorithm for you, automate it like the other software that we provide for you. In my opinion, these candlestick patterns can be powerful tools that will help you in your price action day trading, but you shouldn't just mechanically trade them. You should always consider the whole picture, look at the whole chart, see where the market is going, where it has been. And today's example will be such a pattern, one that can have unlimited variations. There's one core pattern that is usually taught in candlestick theory. It's called the rising three methods or falling three methods. In itself, this pattern is not that good. I have programmed this and tested it, but it's just not that good to base your day trading on. And the reason for that is that the pattern is not that common. You won't find it very often in your charts, and that creates a lot of uncertainty in backtesting. Even if it did produce a lot of good trades, I wouldn't recommend trading it mechanically. But I use ideas from this in my own trading. When I was an equity options trader, I used the ideas from this all the time. So what I recommend you to do is to simply understand what the pattern means, what it stands for. So let's break it down here. This is the original rising three methods. I'll show you how I use it in my own market analysis afterwards. First, you have one big green candle, right? You remember the big green candle from some few episodes ago. So the big green candle is a big, strong bullish move. Then you get three small red candles pulling back towards the same level where the big green candle started. So the market is pulling back to the same level where the pattern started, but the candles should not move lower than the low of the first big green candle. And then finally, after the three red candles, you will get another big green candle. And the idea in the candlestick theory is to trade when the market breaks the high of the first big green candle. So that's the rising three methods pattern. We also have the opposite on the short side, the falling three methods. A big red candle, three small green candles, and then another big red candle. The way I use this, well, first of all, I don't really care if there's one big candle or 10 candles on the initial up move. I think that's irrelevant because I always look at this as an idea, as a principle. What I look for is a strong up move. Then at some point, after one candle or 5 candles or 10 candles, you will get the pullback. Now I look at the candles, I look at how big they are, I look at how many they are. Essentially, I'm simply comparing how much effort was required to make the up move and then compare that with how much effort is required to make the same distance on the down move. And with effort, I mean basically counting the number of candles it took. If the market made 10 points over 2 candles on the up move and then took 10 candles to move down on the down move, that means that the market does not have to work as hard moving upwards compared to moving downwards. The up move was easy, there's a lot of demand. The down move is harder because there's a lack of supply compared to the demand. And the market might not even go down as far, and that's a good thing. The lower it goes, the weaker the market is. So if it reverses back up again near the top, say near the top 1/3 of the big green candle, then the market is strong. If it reverses at the bottom 1/3 of the big green candle, then the market is weak. Anywhere in between, the mid 1/3 is what I would consider a normal pullback. You could just also use the 50% line. It doesn't have to be exact to the decimal, but just eyeball the chart, determine where the half of the green candle is by eyeballing it, doing it manually. Just find the middle of the big green candle. If it reverses above or below that 50% line, the higher up the better. And then when we get the last up move after the pullback, I again compare against the pullback. How much effort is required to travel that distance? Does it happen on fewer candles? Then that's great. If it happens on one or few big green candles, then that's normal, and that's what I'm looking for. If the candles in the pullback and the last big green candle have long shadows, then that's an even better sign. It tells us that the market tried to move down lower, but it wasn't able to. The price was forced back up and closed there. If the market can't move down, then it's likely to move up instead. Okay, and one important thing will be to look at the volume. The volume should be higher on the up moves than the down moves. And what does that tell us? Well, it tells us that there's more demand than supply, and that means that prices ought to move up. There are more and stronger buyers participating than sellers. Everybody wants to buy, nobody wants to sell. So the big green candles or the up moves happen on strong volume, then the pullback is on lower volume. The volume is drying up. Then when the market starts moving back up again, more and stronger market participants are joining in on the trading and volume picks up again. We want strong moves that shows the market's determination to move upwards, and small, sluggish, slow pullbacks just giving the market a breather and lets it regain its energy. Alright, so a few words also on trading this. If you only look at the rising 3 methods pattern itself, only the 5 candles, if you're going to trade that, then you should only trade that in uptrends. The following 3 methods should only be traded in downtrends. The market can be so erratic sometimes that you can see the rising pattern in downtrends and the falling pattern in uptrends, or during sideways channels. In those situations, don't trade it. The idea and the principle of strong up move, weak down move, and strong up move can be used in sideways channels as well. It tells us that the demand is bigger, so the odds favor a breakout to the upside. In uptrends, the principle tells us that the market is strong and that the uptrend is more likely to continue than to reverse. Alright, that concludes today's episode. Please go to daytradetowin.com to download our free Get Started Day Trading ebook and get our free day trading simulator with free live real-time data, and check out our software products and courses. Until next time, good trading.